This is a must-watch video before 2026, and what we're breaking down is my reasoning for why we will see a 2026 bull run for XRP and some of your other favorite cryptocurrencies. The 4-year cycle is done. Throw it out the window. And really, when we look back here, I'm going to show you the data. This all goes back to the liquidity cycle and a business cycle indicator that actually has a much tighter correlation with where Bitcoin, XRP, and our crypto market is headed. And so for those of you guys that have had a rough go with this 2025 bull run that really wasn't, and you're waiting for it to return, you're thinking about giving up, this is the video that's going to keep you focused on what matters most, which is focusing on liquidity, and you better believe it's coming back. Now, we already have the announcements from the Federal Reserve that they're going to be injecting some money into the repo market. We've seen that. They're also going to be doing some treasury management is what they're calling it. Don't you dare call it QE. It's treasury management. They're buying short-term T-bills. It's just another backstop. It's just another form of stimulus. Let the talking head pundits on CNBC and other stations debate whether it's QE or not. What's important to understand is that the Fed is acknowledging they're going to have to bring a stimulus. They're going to have to make that money printer go burr. And this is the precursor to the QE that we are expecting to come in 2026. And we've already been delivered 3 rate cuts from the Federal Reserve here in 2025, with expectations for more rate cuts, especially after the jobs numbers and the revisions that we just got. That is more reasoning for further rate cuts to bring back QE. And this all brings us to what is the ISM. This is the ISM Manufacturing PMI Purchasing Managers Index. Let's break down what this is. This index is a key economic indicator from the Institute for Supply Management that tracks the health of the U.S. manufacturing sector by surveying purchasing managers on conditions like new orders, production, employment, and prices. A reading above 50 signals expansion. Below 50 indicates contraction, and at 50 means no change, making it a vital snapshot of economic activity and future trends. And in fact, we just got a reading and it came in below expectations. Still in expansion territory above 50, but below expectations. And as I mentioned, we're getting ready for that to shift back with the return of QE, with lower rates in an economy that's trying to break free of the shackles that were put on it by the previous administration.